Hi, I'm Merryn Somerset Webb, Editor-in-Chief of MoneyWeek magazine. Welcome to another one of our interviews. I have with me today Paul Mumford, who is a Senior Fund Manager at Cavendish Asset Managers, and also the author of this newish book, The Stock Pickers, which is full of the history of history of your investment career, right?
Correct.
Now, you also run 3 funds at Cavendish.
Yeah.
So let's start, if you don't mind, by just talking briefly about those funds, which ones they are, and maybe a quick run through of your investing style, which is, I suppose, covered in the book. But let's start there.
Well, the career started in '63. Fast forward to 1987, we had the Big Bang, etc., and suddenly stockbroking became less attractive. So I decided to jump over the fence and become a fund manager. I'd been specialising in smaller companies at the time, and decided to start a smaller companies fund. But I didn't want to be kept entirely to smaller companies, so I then decided that I would invest in recovery situations and shares in out of favour sectors of the market. So consequently, between 1988 and 92, I was in smaller companies. Then I went into large companies between 92 and 95. Smaller companies up until the banking crisis. A few larger companies then, and smaller companies ever since. So that's the Opportunities Fund. By 2005...
So it's the same fund all the way through, the Opportunities Fund?
Yeah, that's the same one all
same
the way
fund,
through.
just changing its market cap or
yeah, that's right.
focus.
I changed... I was part of my own firm for part of the time, but I came to Cavendish in '93. It's all in there. In 2005, I found that I was getting a lot of AIM shares sort of coming into the portfolio, and I thought, well, I don't want the Opportunities Fund to become an AIM fund. And so I decided to start an AIM fund, which I did. And I'm told that that's the only sort of pure AIM fund. I think there are sort of micro-cap funds, etc., etc. So that was great. Then we had the banking crisis. Gosh, a load of large cap stocks. I didn't want the Opportunities Fund to be full of large cap stocks. Didn't mind 10 or 11%. So I started a large and a mid cap fund, and I've been running that one ever since. So I've got the 3 funds, and I can manage, all over the spectrum of the market.
Okay, and is the Opportunities Fund then a kind of mixture of the stocks you've got in the other 2?
Not
quite
a big
like
overlap. There is an overlap in places, because if you've got a great stock, then it's a great stock, and even if it's an AIM stock, you can hold in the Opportunities Fund. In the Select Fund, it's got to have a market cap of over 400 million, so it can qualify on times, but there's not a great overlap between the 3, because there are so many great companies in the market today.
Okay, so let's just step back. You said if it's a great stock, whatever portfolio. So what is it for you that makes a great stock?
A great stock is a stock that you can make money out of.
That covers almost everything.
You buy it when it's cheap, and you sell it when it's expensive. You tend to do things that are sort of slightly unpopular, because you're actually buying stocks that are out of favour in unfashionable areas of the market. But
so would you call that value investing? Would you call it contrarian investing? What would you call it?
Money making.
Money making.
It is, yes, it is value investing to a certain extent, because if I like a sector, say for instance at the moment, one of my themes is that at some stage in the dim and distant future, the pound will recover from the current level and it will go back to $1.50.
Why?
Because of, well, once we get over the European hurdle, I think people will quite like to hold sterling, because it's detached from the euro. I mean, would you prefer to hold euros or sterling?
Personally, sterling.
What?
Sterling.
Well, there
myself.
You go.
But you know, you and I might think that, the rest of the world doesn't.
No, not at the moment. And also, you find that any commodity, any currency will drop far more than you think it will before it recovers. So consequently, sterling could easily fall back. I mean, if it fell back to 110 to the dollar, well, you know, I wouldn't be at all surprised. I don't think it will. But I think at some stage in the future, it'll get back to $1.50. It might be talking about 10 years' time, might be talking about 5 years' time. It won't be tomorrow. But at the moment, that's thrown up some huge opportunities for some of the domestic stocks. So coming back to this thing about great stocks, one of the sectors I quite like at the moment is the retail sector, which everybody hates. You've got input prices sort of causing inflation. You've got the living wage putting pressure on things. You've got competition in certain sort of areas of the market. But in certain areas, you can pick up stocks that are yielding 6, 7, 8% on single figure PEs. Now, I would buy those sort of stocks. They would be stocks such as, say, Debenhams, Moss Bros, Laura Ashley, whatever, rather than buying the Assoses or the Boohoos of this world, which have done incredibly well, but are on very high ratings.
And you'd assume that those yields are sustainable, despite the problems we've just discussed.
The yields will be sustainable because they're over my dead body stocks, and you know, these companies have actually been trading quite well. I mean, one of these stocks I've got, which everybody hates, is a company called Bon Marché, which is you know, a relatively small company, and they've actually hedged their currency commitments all the way through to the end of 2017. Now, the retailers, as they're dealing for seasons in advance, would have hedged their currency forward, and consequently, a bit like the oil companies, when the oil price dropped, a lot of them had already hedged forward or hedged on the way down, so they missed the worst of the effects. Now, if a company is sort of giving a decent yield and the yield's sustainable, then you will get the shares will pay for themselves, even if the share price doesn't change. However, things do go wrong, and I've got about 3 chapters in that book of my great accidents, and this is one of my themes. I like to have 70 stocks in the portfolio. I'd like to have a holding, say, of an average size holding is about 1.5%. So if a share goes up and it's 3%, 4%, it's because the share price has gone up rather than me taking a view. And I think that you know, if you've got 70 stocks and one of them goes wrong, you're losing a penny halfpenny the pound. If it's a high risk stock, you only invest 1% in it and you're losing a penny in the pound. But on the other hand, if you've got a portfolio full of great stocks, then you know, you're actually going to see the performance pick up on the back of it.
But some would say that's pretty low conviction stuff, and that, you know, 30.
Sorry?
Some would say that's pretty low conviction stuff, and 30
care
or
less.
40 should be enough to give you diversification.
Yeah, no, I've seen, coming back to sort of experience, you've seen things like Sure Invest, where the John Allman stock, which had 20 stocks in the portfolio, they were all sort of pretty poor stocks, and when the market started crashing and people wanted to get out, then they all started falling away. If you've got a portfolio with even in large stocks, large cap stocks, you get things going wrong. You've got things like, you know, your Pearsons, your Capita, your British Telecom, BP in the past, you know, etc. I mean, look at BP. That was you know, a huge stock for all the income wallers. Once you had this unforeseen event in the Gulf, then the dividend was cut, the share price came back, and everybody suffered. And people said this ridiculous thing: "Oh, we've got to have our weighting, index weighting. We've got to have our 8% in this stock." Why? British Telecom, back in 1999, that company was about 7.3% of the index or thereabouts. Now it's less than 2% of the index. I mean, these index trackers are absolutely staring bonkers. My fund in '99, I've only got one stock left in the fund since then, and it's not being it's being relatively active, but it's not sort of churning. It's just with the way the things happen. And looking at sort of 2008, I've got about 25 stocks in there, because once a stock sort of achieved its potential, I'll tend to sell it. On the other hand, if another stock comes along and says, "Oh, I'm a great stock," I'm fully invested, so I have to sell something in order to make room for it. And you know, it's just a sort of incredible way the thing works. And yeah, wow, you know, it's.
Okay, so we've talked about retail, which is one of your big themes at the moment, right? Domestic retail. What else is there?
Well,
sectors that are really interesting to you.
On the sort of domestic sector, you've got the breweries, which are absolutely unloved. Wetherspoons have performed reasonably well, but I'd be less keen on that. Things like Marston's and Green King, you've got the same sort of thing. You've got the lowish rating, you've got a decent enough yield. On the other hand, you have companies in that sort of area that you've still got some sort of risks attached, like Restaurant Group, for instance, where you can't be sure quite where they're going. Similarly, in the retail space, things like sort of Sports Direct, etc. It's a career-threatening stock that if a broker put you into it and the share price halved, that you're out the back door type of thing. I think also that things like the construction sector in places is fine, and I would think of stocks like Costain, where it's all public works, etc. Things like Kia Group, where they've got a decent sort of property investment side, and so on and so forth.
Commercial property?
Property, you're great, yeah. I mean, property is one of these certain areas of the property market. You can buy property, I was weaned on property, as you'll see in that book. Property is really interesting because you can get shares at decent discounts to assets. I mean, for instance, Granger Estates St Modwins came out with their figures today at a 30% discount to assets. Decent company, brownfield site developer all over the country, and a decent sort of management. Granger, I've mentioned, the largest sort of residential residential property company. Another one that's sort of quite attractive. You've got things like Dejan Property, which owns property around the Marble Arch area, that some of which is in the books at cost. Share price.
Residential or commercial? Commercial.
Both.
commercial with a resident. Some of the blocks of flats around Marble Arch are in the books at a very low level. Got some interest in the US, which will benefit from the pound depreciation. And
so these are inflation hedges to a degree?
To some extent, but I wouldn't buy them for that reason. I don't like American property, to be perfectly honest. But the share price is 63p, and the published asset value is £95, and sorry, £63 is the price, and the asset value is £95, and the asset value is a fairly sort of conservative one. And you've got these sort of funny quasi property companies. You've got one of my holdings that's done pretty well is a company called Lock and Store, which is a self-storage company. Yeah. Now with self-storage companies, particularly the smaller ones where they're nimble and can move from one area to another, you've actually got quite an interesting investment, because as the residential property market moves up, people move around the place, then the occupancy levels move up. As the occupancy levels move up, they can increase their rental levels, and the property value is based upon a multiple of what a company earns. So therefore, it's like having a property company with a rent review every few weeks, and you know, great. But you're also getting the growth in dividend, and you're getting the growth in profits as well. Now that's a great stock. But sometimes you know, things sort of run their course, and I think I said, you know, earlier that I tend to be sort of counter-cyclical, and I tend to do things that people don't really like. And for instance, taking the housing sector, a broker sent me an email one day saying, you've got to sell Taylor Wimpey. You've got to go short of Taylor Wimpey. You've got to sell the shares. The share price is 24p. And I thought, well, I hate Taylor Wimpey because it was always sort of geared up. But let's have a look at it. The asset value at that time was 60p. They were on the verge of selling their North American interests, which would have completely de-geared the company. So I thought, great, you know, I can have my 1% or 1.5% in Taylor Wimpey. If they go up to 60p, then, you know, I'll kiss them goodbye and sell them. So did I sell them at 60p? No, I didn't, because you've got to be hypocritical in this game.
Of course.
So I sold.
Where did you sell them?
I sold them at 107. However, you've got to be even more hypocritical, because I had them in the Select Fund, which is a slightly different animal, because I can hold them for longer, being a large company. Yeah. It's not a recovery stock anymore. So I sold some of them at £2, and then bought some back at 143, and they're sort of 170 or something at the moment. But at the time, people just hated the housing market. Yeah. And again, looking in there, you'll see back in sort of around about the 2000-ish, I had interest in a lot of housing companies that all got taken over. Things like, you know, Prouting, oh gosh, I can't remember the names, Wilson Connolly, Wilson Bowden, etc. So in this last little round, I thought, well, what I'm going to do is I'm going to buy my Taylor Wimpey because that looks sound. I'm going to look at the sector again, and I'm going to buy the companies that have got strong balance sheets, will survive in any case. And two of those companies, one was Galliford Try and the other one was Bovis. Now, Bovis has been a bit of a dog of late, but
You're still holding it?
No.
No.
I've got them in the Select Fund, but I'm not holding it in the Opportunities Fund, nor am I holding Galliford Try in the Opportunities Fund, because they both actually did the business. And effectively, I don't really like the house builders, because although they're going to do well, you're only going to make 25%, 50% of the money. Who wants to hold an investment if you're only going to make that sort of money? What you want
I think a lot of people are very happy with 25, 50%.
I'm not. I want to. Ideally, I want the 10 baggers. You know, those are the ones that are actually going to do well. But if you can find enough of these stocks, then you know the point about having a concentrated portfolio. Yeah, you'll do pretty well with a concentrated portfolio, but if one of those stocks goes wrong, then you're actually going to suffer. And I don't like sleepless nights. I like to have the stocks that are looking pretty attractive. And
now, the other sector you're interested in the moment is oil and gas, right? Or exploration?
Yeah, well, oil and gas I got in pretty early, because if we'd been talking a year ago, you would have turned up your nose when I said, I really love the oil and gas sector.
Oh, I don't think I would. You don't read all my columns,
well,
do you?
You wouldn't, because your comments are sensible ones, but a lot of people would do. But the... yeah, I mean, oh God, the oil and gas sector is just absolutely incredible. There's so many interesting sort of North Sea shares. And unfortunately, of course, some of my biggest holdings now are oil and gas companies, because they've done so well, because I've been in there for a long time. But there's still further to go.
What's your favourite in that sector?
My favourite one, we got a takeover bid yesterday, which
Well, we'll have to go to second favourite.
Hate it. But, I mean, just think of this. You've got a company with a market capitalisation of, well, now it's 490 million.
Which company is this?
This is the Ithaca that's had a bid. You've got a cash flow. It's doubling its production when its new facility comes on stream this month. You've got a cash flow of $230 million. Even if you take off the capex of $70 million, that's going to pay down its borrowings, which are quite high at about $600 million. And the balance sheet will be cleaner after a few years' time. The production facility they've got in place is in the North Sea, and they've got this pretty decent field. But if you look at a map, you get hold of a fountain pen, you stick it in the ink, and you go like that. All those blodges are discoveries which have been found in the past, but they haven't been economic to get out because there's been no facility on board.
But maybe they never will be. I mean, we keep hearing about how much of the oil is just going to stay in the ground forever now. We don't need it.
They've got the facility. They've just put it in, so that they can tie up. I mean, look at Hurricane, which is in that area, and I believe the Hurricane can tie up to this thing. That company has had...
Is this your second favourite?
No, it's not. That's had a massive find, and it's got a market cap of 600 million without having any production at all. Now, admittedly, people are looking at Ithaca on a enterprise value because of its borrowings, but there we go. I quite like Faroe as one of my favourites. They're one of the biggest operators in the Norwegian part of the North Sea. And the great thing about the Norwegian part of the North Sea is, first of all, it's difficult to actually get licenses unless you've been there for a long time. They've been there since 1992. When you do get your licenses, 80% of the drilling cost is paid back by the Norwegian government. So you've got wells that could be sort of drilled relatively cheaply, and you can also get the big company, the Centricas of this world, into them as partners. And a few decent finds from a company like that can be completely transformational. Who wants to invest in things like Shell and BP, where you might make 25% of your money? What you want is the 10 baggers. I mean, Hurricane, bloody hell, I managed to pick up some at 10p, and the price is 53p today, and that's only in the last sort of year. But I mean,
that's
it. What?
Are you keeping it?
Yeah, I'm sort of. They've got another well that's being drilled at the moment, where the result will be due out by the end of the month, which could be pretty sort of significant. So people do, quite like it. Another one in that area is Enquest, which recently did a deal with Shell, where it acquired some of Shell's assets, which effectively aren't really sort of costing them that much. Another geared company, another one that's bringing on production, in the next year, but a great sort of situation. I've got a little dog in the portfolio. Everybody has little. Well, I had two little dogs. I must tell you this. I've had.
Go for it.
I really have had two little dogs in the portfolio. This is why.
Recently, two recent ones.
Oh yeah, great ones. This is why you should have a diversified portfolio, in my opinion. I've had Circle Oil, which has gone bust, and I've had Excite that's gone bust. The reason that both companies have gone bust is because the loan stockholders have actually pulled the plug. And in the case of Excite, they own the rights to the Bentley field up in the North Sea, which is a huge sort of area. They had cash in the balance sheet, but they couldn't repay the loan, so therefore the loan stockholders pulled the plug. In the case of Circle, it was even worse. They had the cash flow to pay the interest, but they couldn't pay the capital, and the loan stockholders, pulled the plug. Wow. However, life is full of these things, and again, if you look in there, you'll find frauds, you'll find bankers sort of pulling plugs when they shouldn't have done, and all sorts of things that can happen because equity investment is a high risk investment, but nevertheless, the winners tend to sort of pay for the losers. So.
Okay, so you are a pretty optimistic investor,
yeah,
obviously.
Well, at the moment, not half. The time not to be optimistic is when the taxi driver gives you tips, when they say it's different this time, and when people start talking about, you must buy this on 20 times 2025 PE, and then they get onto this ridiculous thing of talking about pegs, and they are all excuses for buying stocks. And once this happens, you've got to be out of the market.
So as far as you can see, this is right now in the UK, this is a well-priced market that has a long way to run, in general.
Yeah.
We're at the beginning or the middle of a great bull market.
The market will fall when it looks too expensive. People are telling you it's too expensive. And I mean, we've got this sort of ridiculous situation on bonds. I mean, I'd never have ever dreamt that interest rates would sort of fall below sort of 3% or something. And through this ridiculous quantitative easing, you've now got interest rates down to a level where they can't possibly rise to a substantial amount because let's cripple the economy. But I'd never have ever thought that loan stocks would do this. But I think that people buying loan stocks or gilts start staring bonkers because they're getting a return less than inflation, and inflation's going to go up because oil prices are going up. With the pound dropping away, input costs are going up.
So oil, the pound. What else might add to inflation? Minimum wages?
Well, minimum wage is another thing. And also, I think that because of all those factors, the food retailers, which I'm not particularly keen on, but being a hypocrite, I have got one.
Which one? You can't remember, or you're just not going to tell me?
No, I can remember, but it's a convenience store group called McColl's. Now, McColl's is not a supermarket, it's a convenience store group. And the reason one likes McColl's is the fact that on the one hand they can turn sort of newsagents into convenience stores, they can put fresh products in there. The post office has paid money for them to put post office counters in their thing. They've got Subways in some of their larger stores, and they've recently acquired some outfits from Co-op, which they'll be bringing into the portfolio. So, I mean, that's a different sort of situation. But with
interrupted. Back to inflation. Yeah.
But with the supermarkets generally, the rise in input costs, I think, will take the pressure off the price wars that we're actually sort of getting. And yes, you know, the Audis and the Lidls are sort of coming in and sort of slightly ruining the market. But I think the pressure on prices will be less. And
you mean they'll stop competing on price in the way they are at the moment?
They won't.
Because they won't have a choice.
They'll still be competing because they have to. But I think that you know, certain items will in the shopping basket will, you know, naturally sort of rise, which would be slightly inflationary. House prices slightly inflationary, but you know, seems to be a bit under control apart from areas of London perhaps. And we're talking about house prices, you know, before, and I said, well, you know, I'm out of house prices and house builders in the Opportunities Fund.
Well, maybe down here in the south, but up in the Midlands and up north is different matter altogether, right?
Let me say my but.
Okay, go for it.
But I did buy a house, a housing company, Telford Homes, which owns, which develops properties around the sort of fringe area of London. It pre-sells them, no buy-to-lets. They're relatively expensive, but not as expensive as central London properties in decent sort of areas. They pre-sell them. They're pre-sold up to 2020 in a number of cases.
Pre-sold to who?
And the big trick is they take a 20% deposit from their investors, and it's non-refundable, so they can use that cash to build up the portfolio. And
so people are prepared to put down a 20% deposit on a house now?
No, a flat.
They won't get a flat?
Yeah.
They won't get till 2020?
Yeah.
A leasehold?
Yeah.
A long lease?
Yeah. And
Jeez.
a lot of these investors are sort of overseas investors. And property to overseas investors are a lot cheaper than they, you know, 15% cheaper in cases than they were because of the currency thing.
Do those overseas investors know where the flats they're buying are? Or do they think they can see Big Ben from the window?
Probably haven't got a clue.
And do they understand our leasehold system as well?
I would imagine that if you're a wealthy investor and you're spending that sort of money, that you would know roughly where they are. But then, of course, some of these haven't actually been built yet. So, you know, it's a sort of funny old situation. But nevertheless, you know, it's an interesting sort of type of company.
Okay. So tell me, apart from bonds, what would you not touch with a barge pole at the moment?
Now, if somebody's saying to me, I'd like to recommend, a broker comes up and recommends an IPO or recommends a share for the AIM fund, for instance, I'll ask them a number of questions. I get so many of these IPOs silently, I don't want to do the whole lot. And the questions are, first of all, is it a loss maker? Yes, it is, but it's breaking even next year. Well, don't rely on those forecasts. Secondly, is it an overseas company coming onto AIM? No, forget it. Don't invest. I wouldn't invest in that because I've seen sort of mishaps there. The third thing would be, I suppose, to some extent, it's the size of company, because in the AIM fund, my minimum investment is sort of 700,000. So if you go too small, it's got to be a really good investment. It's got to be a fixed asset. In the Opportunities Fund, the size is about a couple of million quid. So, you know, again, you're sort of slightly moving up the scale. I don't like financial companies in AIM. Well, don't say that, because I'm just in the process of buying a financial company.
This is very hard to pin down what's going on here. Everything has an exception.
I'm just in the process of buying an IPO for AIM that's a foreign company.
A foreign financial company.
That's based overseas.
Presumably it loses money as well.
Yeah, it's based overseas. And no, it's not making a lot of money. It's based overseas, and it's a sort of AIM listing, and it's a financial company, but it's one I can understand. But yeah, financial companies I'd avoid. I tend to avoid the mining sector because I don't understand commodity prices. I'd avoid...
Do you need to understand commodity prices, or do you just need to understand the capital cycle for mining shares? I thought you'd be good at that.
I couldn't tell you whether copper's going to go up or down, or whether, you know, sort of gold's better than platinum. Or
but why is that commodity cycle different to the oil and gas
well,
capital cycle?
Because oil and gas runs out, and you know, copper doesn't.
But it doesn't really, does it?
Well, I think when you look at BP and Shell and Exxon and all the rest, they're having to actually find some pretty vast reserves in order to replace the ones that are actually sort of being used up. And oil and gas will someday. You can't you can recycle oil.
But you don't think that the rise of renewables as solar becomes more efficient and easier as wind ever become more efficient? But doesn't that mean that in the end a lot of this oil will simply stay in the ground? Will never come out.
Quite possible, and also, of course, the other thing is electric cars, and they're more efficient. So that's going to be another factor. But on the other hand, the reserves of copper or nickel, sort of, well, not infinite, but well, I just don't understand the prices, and I
Fair
feel
enough.
that
Not even gold. No gold companies in the portfolios.
No gold companies in the portfolio.
Any physical gold hidden around your house at home?
You're trying to get me to tell you one that I've got in the portfolio that I'm being hypocritical about. Yeah, I've got yeah, okay. I admit, I put my hand up.
What is it?
I got Sylvanian Platinum in the portfolio of the AIM company, and it's done me pretty well. And it's a sort of relatively sort of lower risk one. But I've also had shares in that area of the marketplace that have. In fact, I went out to South Africa once to. I've got losses on. This is why I'm not keen, because I've lost money on some of them. I had a thing called International Ferrometals, which was a great story, and I did make money out of it for the Opportunities Fund, because luckily it went up to the main. It went up to the main market, and I decided to. So generally nowadays I don't look at mining companies, but I have done in the past. Okay. It's a learning by mistakes. And the other area that I'd avoid like the plague would be biotech companies.
Because it's impossible to tell whether it's going to work or not.
Never come through. They throw their money at it. It's too expensive to bring drugs to market. Invariably, a large proportion of drugs just completely fail. Okay, now you're going to ask me which biotech companies.
Which biotech companies you're holding?
Well, I've got a thing called ErgoMed, which is a slightly different one, because ErgoMed actually does work for biotech companies for which it gets paid. It also finances some biotech company drugs. And rather than taking an interest in the company, it will take an interest in the drug, which is great, because as the drug goes through its milestones, they get a proportion of the milestones, they get a proportion of the royalties if the thing should actually work. One might one day, and it's a profitable company, so that's okay. In that, I think the healthcare sector is really sort of quite good. But I mean, who wants to buy Glaxo and Zeneca? Well, if you're a large fund, you've got to. When you can buy smaller companies which haven't got the same sort of risk and which are fairly sort of nimble, and you can make a great amount of money out of them. And I mean, another.
I thought we weren't going to buy them. No,
Sorry?
You've just presented a wonderful case for buying biotech companies, just after you told us not to.
No, they're not biotech. That's not a biotech company. That's a company. Well, I'm not making the case. I'd make a case for healthcare companies. I mean, for instance, Clinigen, which is another one, that will buy successful drugs and market it. Okay. But it also supplies products to biotech companies. Now, if you're a biotech company and you're doing a test on a product, and you're doing that test against another product, then you've got to make sure that the other products is of equal consistency, the same batch, etc., and you've got to have somebody independent to certify that so they don't cheat. So Clinigen supplies those products to the biotech companies or other companies doing research. So they get paid. They don't have any risk of getting things through, the phase 1, 2, and 3, and yet they will sort of benefit from it. I mean, there's some other great sort of companies. You've got devices companies and some manufacturing companies. Because I think healthcare is generally a pretty good idea. But but biotech.
Okay, now, if you had to pick one stock from all your portfolios,
I would
as a favourite.
I would choose 3 stocks.
All right, 3. Okay, 3.
I'll tell
Just
you
for
what,
your layout 3.
if you give me a bit of paper, give me a pen.
It's not a pen, it's a rather sort of bitten pencil. So
I can write it, okay. Do you mind if I put
No, go for it.
I'm going to write 3 stocks down on this list.
Okay.
And you are going to pick one, and that's going to be my favourite stock.
This, by the way, readers, is how investing works. It's a bit like
I did
gambling.
I did this once at a presentation, and I had a box full of 50 stocks.
Come on.
Okay.
What, and pulled out one to be your favourite?
Yeah. I've got a hat, so I can put it. Drink that.
You'll have to just hold them in your hand.
No, I'm going to throw it on the table. I don't want.
I'm looking forward
don't
to
want you thinking I'm a magician with
I'm
it.
looking forward to you rushing out
With it.
after this interview and topping up your holding whichever stock I pick.
Right. Here we go. 1, 2, 3.
Okay, here we go. One in the middle, you know? What?
Go on.
You think it's a bad choice?
No, go on.
Have another go.
Go on then. I don't know. All right.
Well, it says Cavendish AIM.
Cavendish AIM Fund.
Here we go. Buy the fund.
Yeah.
They all say Cavendish AIM.
No. No, that one says Cavendish Opportunities Fund, and the other one says Cavendish Select Fund.
Okay, there you go. Your favourite things are your funds.
I mean, the problem is I've got 70 stocks in each fund.
Yeah.
A lot of them are my favourite. I couldn't pick out one stock, and you know, it's just you know. What you could say instead, you could say pick a sector, and I can pick a stock in a sector if you want.
Okay, pick a sector. Oh, I pick a sector.
Yeah.
Okay, retail, domestic retail.
Okay, well, I will go in that case for Moss Bros.
Moss Bros.
It's going to be a
The very
boring
idea
stock.
of Moss
The share
Bros makes me
price
laugh
never
slightly.
changes. It's a good management. They're seeing their way through the living wage thing quite comfortably by changing the sort of wage structure where people previously had a sort of bonus, and now the bonus is being reduced and their wages are going up.
So people's net income isn't rising?
Sorry?
So employees' net income isn't rising, you mean? Because their bonus is gone, it's been folded into their
No,
wages.
the bonuses haven't gone. The bonuses are there. They're getting the advantage of having a higher certainty of the wage, and the bonuses will go up depending upon how they trade. They're quite well sort of trained, so that they are customer friendly. The thing that people don't realise about these domestic companies is that they've all got growing internet side, which can open up sort of overseas areas. Their traditional business of sort of hiring suits, etc., is actually sort of doing reasonably well at the moment. And they've got a decent range of suits they're actually selling. It gives you a good yield, strong, but they've got about, I can't remember what the balance, 18 million, something cash, net cash in the balance sheet. So they can afford to continue paying the dividend and trading pretty well. But don't expect them to go up in the short term because people don't like the sector, they won't invest in the sector. But great for me because that's what I want to do, you know, rather than sort of going into the high flyers. Like, you know, the banking sector at the time of the crisis. Yeah, I lost money on Northern Rock. I didn't lose. Yeah, it's in the book. If you don't believe me, look in the index. And I didn't lose as much money as I might have done because I did cut my position because, you know, I went into it, you know, sort of on a false premise. But what I did do, I bought the 3 horrible banks, RBS, Barclays and Lloyds.
After the crisis?
Sorry?
After the crisis? When did you buy them?
I bought them when nobody really liked them at ridiculously low levels, I sort of took a profit on them fairly sort of early on, but they just looked you know, ridiculously good value, and but nobody liked them at all. And the big lesson again that I found, again it's in that blooming book, was the 73 cat crash. Love it. 73 crash, and would you believe? I mean, what would you feel like if you were investing money for your parents? You had your parents' portfolio, and they didn't have much income apart from that, and share prices were sort of going down, and you know, you feel pretty sort of dreadful about it, and And then I was sort of dealing for, well, read more about it there, and I learned the lesson that you've got to buy when things are bleak. Markets overreact. You've got to buy then. You've got to sell when everything's rosy, when the market's really at the top. And when the great thing about a market fall is that this is where you can find the great stocks.
So we should be longing for market falls.
Why do you find the great stocks in a falling market? In the smaller company area, it's because smaller company funds tend to have withdrawals. The fund managers have to sell. What do they sell? They sell what they can sell rather than the rubbish which they can't sell. So consequently, you can find some really sort of fantastic bargains at those sort of levels because everything sort of goes down. Valuations are completely out of the window. And yet, you know, you sort of look beyond that and you think, well, yeah, this is a real great time. Love bear markets. Well, wow, what an opportunity to go into things. It's really great.
We're going to have to leave it there, Paul.
We've only
Thank you.
started though.
All the rest is in the book. Well, I think everyone's had enough share tips to be getting on with. Thank you very much indeed.